Hey everyone, and welcome to this brand new video. Today we're going to be looking at some of the best strategies developed by our students at Unger Academy. Now, these strategies were first analyzed and then corrected by us, the coaches of the Academy, and the best ones, those that proved resilient over time, were included in this workspace, which is, of course, available in an extended form to all our students. Today we're going to be looking at some of these strategies, and we'll explain the rules in broad terms so you can see how intuitive it is to develop automated strategies using the Unger method. Before we begin though, I invite you to please subscribe to our channel, click on the notification bell, and why not leave us a like on this video? Thank you so much. Hi, we are the Unger Academy, and we teach traders how to make money in the markets. Our founder, Andrea Unger, had been struggling with trading for years until he developed his automated trading method, which he used to become the only 4-time world trading champion. Subscribe to our channel for free tips and tricks. So let's start by analyzing our workspace. Now we can see different instruments with obviously different strategies inside. In the upper left corner, we have the US, which corresponds to the 30-year bond futures. Then we have the HG, that is to say copper, which is a commodity. Then we have another commodity that certainly needs no introduction, crude oil. Then another commodity that needs no introduction either, gold, with two strategies that we'll look into in a moment. And finally, we have live cattle, which, as we know, is one of the futures of, the meat sector. So let's go and start with the first strategy. This is a mean reverting strategy. And interestingly, the peculiarity of the system is not so much in the entries as in the exits. As for entries, they may vary between 1 or 2 contracts, and the quantity chosen depends on whether the previous day was negative or positive. For example, we see that in this case, the previous day was positive, and so here we'll enter with a single contract. On the other hand, in the case of a decline, we'll enter with 2 contracts the next day. And this is really because these futures, and bonds more in general, respond very well to the mean reverting approach. So this strategy was developed by one of our students in 2018. So let's see. The development date, it's more or less here. And as you can see, also, the out-of-sample performance is pretty good, especially if we compare it with the buy and hold of this underlying, which went through some very difficult years. I mean, look at those declines. However, although the strategy only enters on uptrends, it still managed to make some excellent gains. The strategy closes its positions after 10 bars at the latest. Now, since it's a 60-minute time frame, the position can remain open for a maximum of 10 hours. Okay, so let's turn now to another strategy. This is a mean reverting strategy on copper and uses Bollinger Bands. It was developed on a 30-minute time frame. And again, we have a strategy that stays in the market for a few hours because we have exit conditions at certain times of the day. And here is also the report on the strategy. We can see that at the beginning of the out-of-sample period, the equity line had suffered a little bit. However, in the last year and a half, it's been able to recover and achieve a much better performance. Actually, the mean reverting logic is one of the strongest in this market. So I definitely recommend you go and try it out. Let's move on to the next strategy, the one on crude oil. As I told you, this strategy and in general this market responds well to trend following strategies, which is the opposite of the copper strategy that we saw just a little bit earlier. Specifically, this strategy uses information provided by an indicator called a rune. Over the out-of-sample years, the strategy has been able to hold up very well, and it kept in line with its past performance even in the last 6 months, which we know have been characterized by higher volatility due to the war in Ukraine and events regarding energy commodities, mainly natural gas and crude oil. But let's move on to the next strategy. This one works on the gold future. It was also developed on a 30-minute time frame, like the previous one, but in this case, we change logic again. We've moved from mean reverting to trend following, and now we're looking at a bias strategy. So this strategy will enter at certain times within the session and on certain days of the week. Especially in the second part of the day of the session, we'll make long trades, while on the other hand, in the first part of the session, we'll make short trades. This strategy has undoubtedly performed very well over time and continues to do so, albeit with a somewhat flatter slope of the curve compared to the early backtest years. Nevertheless, you can see that the strategy is close to equity peaks. Now, these are all replicable strategies, and all our students can use them. Let's turn to the second strategy for gold. As I mentioned earlier, it is similar to the previous one. So it's a bias strategy, and this time is based on a 60-minute time frame. In this case, it makes, well, no difference, since the entries occur in a somewhat similar way. And also in this case, we'll make the long trades in the second part of the day, and instead the short trades in the first part. Now, this strategy has held up very well in the out-of-sample period. And look at what a nice equity line we can get in this market. And now for the last strategy that I want to show you today. It's a strategy for live cattle, so the meat sector. And this is a mean reverting strategy that enters after a false breakout on the previous day's highs and lows. Specifically, long entries will occur the moment the market breaks through the previous day's low. And then, if the market goes above that low again, we'll buy. And vice versa for the short, where we'll wait for a false breakout. So, for example, in this case, here is the high of the previous day. The market made a false breakout because it broke out and then recovered. It returned below the previous day's high, and at that point, the strategy opened a short position. This system has also proven to be very successful. In recent years, this type of logic has produced excellent results in this market. So please, I recommend that you go and try it as well. Now, these strategies have all been programmed and developed using the Unger Method, which is a trading method that can be learned very easily, even if you have no experience in programming. Trust me. And if anyone among you is interested in the world of systematic trading, I recommend that you go and click on the link in the description of this video. And from there, you can go and watch a free presentation by Andrea Unger, or get our best-selling book by only paying the shipping costs, or even book a free strategic consultation with a member of our team. And if you like this video, please be sure to leave us a like, subscribe to our channel, and click on the notification bell to stay updated on the release of all our new content. And that's it for today. Thanks so much for watching, and we'll see you soon in our next video. Bye-bye.